Hello, ladies and gentlemen. Greg Michalowski from ForexLive.com. This is a Forex quick look at the New Zealand versus U.S. dollars. We head toward the FOMC rate decision. It's now time to look at the technical levels in play to create your roadmap for that currency pair if you decide to trade it during the FOMC rate decision. So let's get started. What you like to do when you have a big event, and the FOMC rate decision is going to be a big event. There's a lot of things that's going to go into the witch's brew that are going to determine whether it's more bullish or more bearish, and that's going to be reflective in the price action. And when the price action is in play, we also have technical levels in play. And when the technical levels are broken, either to the upside or downside, that leads to either a more bullish bias or a more bearish bias, depending upon which way the technical levels are broken. So with that said, let's take a look at the technicals that are driving the New Zealand versus US dollar. And what we know in trading here today is that the price moved down in the Asian session, was helped by a lower food price index coming out of New Zealand today. I think it's the fourth out of fifth month that the food prices have gone down, a key measure of inflation or key component of inflation in New Zealand, and that helped to push the price to the downside. Also, the central bank changed their policy guidelines or I think it was legislated actually, where they're not focused on employment and inflation, they're focused on just inflation. So with the food price index moving lower and that change in policy, we saw the New Zealand versus US dollar head to the downside, and the low price, however, did find or install near a couple of technical levels. One is the 200-day moving average. That's the green line in this chart. That level comes in at 0.60878. And going forward, if we were to make a roadmap for the New Zealand versus US dollar through the FOMC rate decision, getting below and staying below that 200-day moving average would be a step into the more bearish bias. And if it were to get below that level, then we'd look to get below this swing area. The swing area is defined by a number of different swing highs and lows going back in time through here. And then we started to find support before moving to the upside. It wasn't until today that we price moved back into that area. So you could see the level's importance. If we get below the 0.6078, it would open the door for further selling with perhaps the 38.2% retracement of this trend move, which goes all the way back to I think it was end of October, 38.2% retracement. Always needs to be broken after a trend type move. You have a big trend move to the upside. You want to get below the 38.2 to prove that the sellers are mean business. If they can't get below 38.2% retracement, guess what? They're not taking control. The buyers are still more in control. So those would be the targets on the downside. Get below the 200, get below the swing area, get below the 38.2. That's a roadmap to the downside through the FOMC rate decision, where the New Zealand versus U.S. dollar would imply a higher U.S. dollar. Okay. Now on the top side, we have seen a rebound higher in the North American session, and it's approaching these hourly moving averages. This green line represents the 200-hour moving average. Blue line represents the 100-hour moving average. And getting above those levels would be more bullish. Now, people are going to say, well, he went right above it yesterday and wasn't more bullish. Well, that happens. When the price moves above that level, we try to extend higher, and then we came down to the 100, tried to extend higher again. And we did through the CPI data again yesterday, which was kind of bogus, and then rotated back to the downside here. So when we fell back below both the 200 and 100, what happened? The buyers turned to sellers, and you could see that right here in the Asian session where the sellers were leaning against a 100-hour moving average, push price to the downside. So getting above those moving averages may fail. That's okay. That's part of trading, but you need to stay above those levels, okay? If you're able to stay above the levels, then you have the opportunity to move higher and away from those moving averages. So this would be the roadmap for the on the upside, is to get above those levels and then move toward this swing area right here, or this swing level right here near 0.6191. This level corresponded with this swing high right here. And also then we moved above that level, and we started to use that level as a support right through here before moving back below that level and then retesting the level in trading last week at the highs on Friday, I guess. And so getting above that level would be more bullish, and then look toward the high price that we saw in trading in the month of November. So that's the roadmap for the New Zealand versus US dollar, and a little bit of reasons why you as a trader need to build that roadmap is to understand where you're going and what needs to be done to either increase the bearish bias or increase the bullish bias for this currency pair. Right now, the bias remains a little bit more to the downside below the hourly moving averages, but there's a battle going on between the 200-day moving average and the hourly moving averages on the top side. My name is Greg McCloskey. I hope you learned from this video. Good fortune with your trading. Bye-bye now.